All right. So thank you for coming in today. Again, I hope the food and the coffee is okay. And today we'll talk about Social Security and different types of income planning and retirement planning in general. Some important topics that keep coming up, and of course we have asked all of you, I know Elena called out to specifically ask what was most on everybody's mind. And Social Security, Medicare came up a lot, also taxes, and people worried about the economy and the recession as well. So that's what we're going to cover today. One other thing is, certainly don't want you to think that we're here to sell you something. This is educational nature. We're not brokers. We don't work on commissions off stocks or anything like that. So, can't go without the disclaimers. And I'm not going to read all of that, but basically what it's saying is this isn't personalized, individualized advice because I don't know your individual situation. So this is general information for informational purposes only. So afterwards, if there are additional questions, and so when we go through this talk, and it's information that it's a lot of information. But if you have specific questions, I'm glad to talk with you a bit individually afterwards, or we can set up a, if you'd like a longer chat, a longer conversation, we can certainly set up a time when it's convenient for us and for you. So a little bit about our team, Sovereign Wealth Management, and this David Jeremiah is so new to the team, we actually don't have his picture yet, haven't had it taken yet. But so we're headquartered in Tysons, and so Elena, she's in the back, she's our operations manager, operations director, and Stefan handles client services, Katya handles a lot of marketing, and we have a financial planning associate who's David in the back. And the way we started, one of the first financial planners in the DC area was Linda English, and that was in the early 80s. She had a firm here. I started in financial planning and investment management in early 2000s, and I worked for Morgan Stanley, Merrill Lynch, the big firms. I realized the bigger they are, the further you are away from the clients, and the more things interfere, corporate type of things interfere between yourself and the client and the experience. So after working for the big firms, managing several $100 million for those companies, really wanted to have a more independent approach with financial planning and investment management. And I found Linda was on her way to retirement, and took over her, partnered with her, took over her practice, and then we've been growing ever since. And we have clients, a lot of clients in the DC area, but all over the country and several continents as well. A little bit about my family. Again, that's my wife and I and our 2 kids in the summer. I'm sans beard now, but we're a little hairier back then. And really enjoy Florida. My mother lives in Jacksonville, so we visit there quite often. So let's start with Social Security and the basics. And the biggest questions about Social Security, of course, is the timing, because there's a lot of uncertain facts around Social Security, like how long you're going to live and so forth. So we'll get into all of that. So the very basics, minimum age to draw Social Security is 62. You get 75% of your benefit. Full retirement age, 66, 67, depending on when you were born. And maximum age to start drawing is 70. There's a cost of living adjustment, which was nice and juicy last year and this year. And so on average, it's been about 3.69% last 20 years. Lower inflation, so lower adjustment, 2.15%. This last one in 2022 was 5.9. And so of course there's a tax that we pay for it, and it tops out at $147,000 on income. So again, of course it depends when to take Social Security. If you know how long you're going to live, then it makes things simple. If you know you're going to live until 72, of course you would want to take Social Security at 62. But how do you figure this out? Well, some statistics for you. So 50% of men that are 65 years old right now live until age 89, and 50% of women live until age 90. 25% of men live until 94, 25% of women live until 96, 5% of men live until 100, and 5% of women live until 102. So when you are considering the longevity factor, you want to think about not the general life expectancy, which is 76.8, but you want to think about life expectancy of someone that's your age. And because the general life expectancy has to do with somebody born right now. And for a 62-year-old right now, life expectancy is 82 for males and 85 for females. So a little bit on some general strategies to think about when you're thinking about when to take Social Security. So if you're married, what often happens is the lower, so the younger person in the family and the lower earner, they want to begin taking their income at 62 and let the spouse's income build up until they are 70, so that you're getting some income in the meantime while the spouse, the higher earner, really builds up that nice juicy benefit at 70. In the meantime, because what's happening is during that whole time, since one of the spouses at least is working, or you may both continue to work during your 60s, you have a high tax bracket because you have a higher income during that time. So you certainly probably don't want to take both of the incomes, both of the Social Security benefits at that time. If divorced, you need to have been married at least 10 years to qualify for the ex-spousal benefits. And if you were married before age 60, then the survivor benefits are not available until the marriage ends. So if you get married, you have to get divorced again if you want to get that benefit. The primary earner has to be age 62 before the divorcee can file for the primary earner's benefit. The divorcee spouse can take either their own benefit or 50% of the primary earner's benefit. Now, the survivor benefit is also something that touches some folks. We're going to cover kind of all the bases we can. So there's a survivor. So if the survivor benefit is less than your own benefit, then you can start receiving your survivor benefit at age 62, keep working, and then switch to your own benefit at full retirement age of 70. So that's a nice little add-on to kind of boost your income. If your own benefit is higher than the survivor benefit, then you can start getting the survivor benefit at age 60 and switch to your own at age 70. So for a divorce survivor, they receive the higher of their own or the deceased spouse's benefit. So if the primary earner never filed or filed at or after their full retirement age, the divorce survivor's spousal survivor benefit will depend on their age when they take it. If primary earner filed before full retirement age, the divorce survivor would receive the higher of the amount the primary earner was receiving, or 82% of the full retirement age benefit. The determined amount would be adjusted for divorce survivor's age. Again, so we can run a report. There's a lot going on here, so we can certainly run a report to make this, to put it on paper, so to speak, if there's a specific situation. So what has changed in the last decade or so? There were a few, you could say, loopholes in the Social Security system, like the file and suspend strategy and the restricted application, which you could almost say you were double dipping, the way you could play between your own and your spouse's benefit, but those are not available anymore. So why is planning so important? So this is Ron and Nancy, and they're currently 60 and 58. Their monthly benefit at retirement, at full retirement age, is $3,011 and $2,235. Life expectancy 85 and 90. If they both start their benefit at 62 and they live to their life expectancy, their cumulative value of benefits is $1,659,336. So a pretty hefty sum. The same couple with the same factors. If they start their benefits at 67, at full retirement age, they will have a full lifetime benefit of $1,944,000. So we're looking at almost $300,000 more. If they wait until age 70, the latest they can start, their benefit will be $2.126 million. So almost $500,000 more than if they had started at 62. So it seems like an easy decision. Well, I should just take my income or take my Social Security at 70. Well, of course, you have to live until your life expectancy. Another big, very important factor in your Social Security planning is inflation. And so what you see here is a loaf of bread in 2000, 2020, 2022, gallon of milk, movie ticket, I'm sure if you plan to travel, Carnival cruise or Royal Caribbean cruises, Norwegian cruises and so forth, vacations, everything goes up in price. Is your Social Security benefit, when you wait for it because you're not getting it now, you're foregoing the benefit and you're building that value, is it really building up at 8% per year in real terms, even with the COLA, with the cost of living adjustment? Or is that cost of living adjustment really lagging and you're missing out? So the break even, meaning what age does it not matter whether you take your Social Security benefit at 62, at your full retirement age around 66 or 67, or you wait until 70, the break even is right around 76 or 77 years of age. And again, that's if you assume that inflation is not a factor, that the COLA fully adjusts for inflation. And you can see the comparison of cumulative benefits, of cumulative payments over 30 years. At age 72, of course, you only will have had 2 years of payments. If you start at age 70, it's a much smaller sum. But once you get to 82, if you take your payments later, they really outpace those who take their payments early. Now this is, you could say, proof that the government, as much as we just adore our government, is not completely honest with us about the CPI, the inflation rate. And therefore, when there is an adjustment to when there's a COLA, cost of living adjustment to your Social Security, it's not the full inflation adjustment. So what you see here is just the Big Mac factor, so to speak. This is it's almost comical that people use this, but it's very accurate actually over decades, how it tracks inflation. So the CPI, if you were to trust the CPI estimate, so the price of a Big Mac was $3.78 in 1993. It has increased in price 66%. Or what we're saying is now it should be $3.78 because it has increased in price $66 or 66% since 1993. In reality, the price is $5.06. The increase since 1993 is 122%. So the government figures the CPI estimate 66% since 93. Reality, 122%. What does that tell you? The real inflation rate is about double, so 66, 122, is about double what the CPI is. So if you're waiting for your Social Security benefit, if you're waiting to take it later because you think you're getting the 8% adjustment every year, well, is it really 8%? Because the inflation rate, the COLA adjustment that's being built in, is it really giving you that full adjustment? Right, so that would make me feel that since COLA is unlikely to keep up with inflation, the benefit of future increases in Social Security income due to waiting longer is substantially reduced. So this may skew you towards thinking about taking the benefit earlier.
Plus, they took away one of the meat patties.
Exactly. Yeah. I mean, and I guess it still tastes pretty good, but it's not what it used to be. Now, another factor that I guess you could say would stop you from taking Social Security earlier is the fact that if you make over $21,240, and if you start your Social Security before full retirement age, then for every $2 over this limit, $1 is withheld from the benefit. So it's a penalty. In the calendar year where you turn full retirement age, so that income level where the penalty begins is $56,520, and for every $3 over the limit, $1 is withheld from the benefit. What is counted towards this earnings limit? Strictly wages and net profit if you're self-employed. Not counted is your pension, annuities, investment income, interest, veterans benefits, and other government or military retirement benefits. So it's only if you work. This number matters. If you do choose to take your Social Security early and you do exceed this amount of income, then it's advisable that you inform the Social Security office that you're going to, the Social Security Administration, that you're going to exceed it, so that they withhold part of your income early. Otherwise, they'll just subtract it whenever they figure out that you're exceeding, which may be kind of a pain for you in terms of figuring out your bill and so forth.
Excuse me. If you wait till 70 to take your Social Security, does that increase that income level?
Well, it doesn't matter after full retirement age.
Okay, so it's
at full retirement age, this goes away. So there's no penalty. And it's important to say that withheld funds are paid out as part of recalculated benefit at full retirement age. So once you get to full retirement age, it's not like you get penalized and the government keeps that money forever. You get that money, but not all at lump sum. So when you turn 66 and a half or whatever your full retirement age is, that withheld amount, that penalized amount, gets built into your overall benefit that you get over the rest of your life.
Excuse me.
Yes?
Is this a good time to ask you a question?
Well, so for the most part, I think,
Oh,
thank you, yes. So it's best to just hold off on the questions until the end.
Okay.
So that way I can individually answer your questions, because I'm glad
so
to
since it
go
was
afterwards.
related to this topic, but that's fine.
Sure, yeah, so just at the end, I think, and you'll enjoy it as well, because I can take a little bit more time.
100%.
Sure. So a lot of federal government employees here, obviously. So we've got the FERS pension in place, and that can get quite complex as well. And so we have requirements for unreduced benefits, 30 years of credible service, and minimum retirement age. Of course, minimum retirement age depends on when you were born. The earlier you were born, the lower the retirement age. 20 years of credible service and retire at age 60 or age 50 under special retirement provisions. We look at a few of the other factors here. So unreduced, so service requirements for reduced benefits, 10 years of credible service, 5 years of which are civilian, and retire at minimum retirement age. If we look at this here, so with 5 years of service or more, a federal employee covered by FERS can leave federal service whenever they choose and still claim unreduced retirement benefits. but you do have to wait until age 62 to receive your retirement income. This question I get very often is, if I'm a FERS retiree and I'm getting the pension, do I still get Social Security? Yes, you still get your Social Security. The way your pension is calculated as a FERS employee, you calculate the years of service times the average of the highest 3 years of compensation times 1.1%. But the postponed and deferred retirements do not get the 0.1% boost. You only get that if you wait until 62 to take your income and you retire immediately. That's how you get that 0.1% extra. Sick leave gets added to pension calculation, but days fall off. So use your sick days up that don't add up to a month. So meaning, let's say you were great, you never got sick, you were super healthy, drank all those green shakes and everything, and you had like, I don't know, let's say 85 days, or let's make it easier, 66 days built up of sick leave when you retire. So that's going to, so you're going to get 2 months. So 66 divided by 30, let's say it's 2 months worth of service that's credited towards your pension. But those 6 days are going to get, going to fall off, and you'll just waste them. So it's advisable to get sick for those 6 days right before you retire, and then get better quickly. If you want to get your annual leave as a lump sum, if you don't use it during your retirement year, retire December 31st so that you can get that credit. Pension starts on the 1st of the month following retirement. So retire at the end of the month. So if you retire on, let's say, February 2nd, or let's say, May 2nd, you have to wait until June 1st to start getting your pension. Why not just retire on the last day of May so that you have uninterrupted compensation? So at least 6 months ahead of retirement, make sure all of your career documentation is up to date with Office of Personnel Management, standard Form 50 in electronic official personnel folder. Pay attention to calculations for military time, part-time, intermittent service, and leave without pay, because sometimes those numbers can get messed up and become quite a pain to get it all fixed before you retire. Last thing you want to happen is you think you're retiring, you have a leave vacations plan, and then they tell you, well, you have to work for 6 months to qualify for that pension.
Excuse me. Are you going to talk about the Social Security supplement if you retire before age 62?
I can cover that with you afterwards.
Well, I know about it. When I retired, I'm like, what the heck is that?
Actually, I wasn't going to cover it in the presentation today, but that's a good point. But certainly, anybody that wants more information about it, I'm glad to discuss it afterwards, or in a session. So, if you take your Social Security at 62, so if you do decide to take it early because you think, well, I don't want to deal with the inflation, with the uncertainty of what that money is actually going to be worth down the road, I don't know how long I'm going to live, and so forth. What does that strategy entail? The pros and the cons. Well, the pros is you have more control over the resources. So let's say you're taking it just to have the money saved up, and you are not going to spend it all. You're just going to have that Social Security check build up in your investment account or in your bank account, like a CD, or just invested in treasuries or something. That gives you control over the money. It's growing for you, and because you're getting that lower payment, whenever you do need it, let's say decades down the road, that money is there for you to supplement your income, because your income from the Social Security check is lower overall. You took it earlier. This is a big kind of a sneaky point. Several types of taxes, they don't actually adjust for inflation. And what happens is the higher your income, or even if they do adjust for inflation, they don't adjust enough for inflation. So it kind of creeps up on you, where these new Medicare taxes and investment income taxes, whereas they were for the very wealthiest people in the past, now many other folks who wouldn't really consider themselves wealthy, just comfortable, are now getting hit with these taxes. So if you wait until you take your Social Security at age 70 and you have higher taxable income, you're also going to be probably subject to more chance that you'll be subject to some of these taxes versus you just taking the Social Security earlier and have lower income because you have a lower Social Security check. And then you're just building that up in your investments so you can supplement your lower taxable income later with your investment income. So of course, we already talked about this. So you're reducing the potential risk of COLA lagging real inflation, which we already discussed. Of course, the cons is it requires discipline. So if you're deploying this strategy not because you really need the money, in which case you wouldn't be thinking about this anyway, you would just take the Social Security as early as you could. You need to not spend that money. So the strategy is build up this kitty of money for later when I need it, when my check that's coming in is not really, my pension that's coming in is not enough. You actually need to not spend it and save it for later in an investment account or in your bank account, like a savings account or treasuries or anything like that, and not actually spend it on something that you want to do. Of course, for people who are just comfortable, who like getting their monthly checks, we're used to that, well, you're going to get a lower monthly check later. And you have to plan it carefully. Given that many that are still working and filed prior to full retirement age would pay the Social Security earned income penalty, and again, that penalty gets withheld, and then they don't give it all to you as a lump sum, they just spread it over the entirety of your life expectancy. So Medicare, for people 65 and older and those with disabilities. So you have to be a citizen or legal resident and live in the US in the 5 years before you are eligible, or before you draw on it. And you also have 10 years, have to have paid into the Medicare taxes for 10 years to get the Medicare without any kind of penalties. The initial enrollment period is 7 months around your birthday. So 3 months before, the month of, and 3 months after. The general enrollment period, so that's if you chose not to take your Social Security right away for whatever reason, maybe you're working and you have coverage that Medicare accepts as something that you can have in lieu of Medicare. And then there's a general enrollment period, which is the first quarter of every year, and the benefits start the third quarter of every year. Now, if you retire, so you don't have health coverage that qualifies, but you still don't take Medicare, then you have to deal with this penalty, 10% penalty, premium penalty for every year that you are late to enroll. Part A, of course, is hospital insurance, no cost unless receiving Part A services if you or your spouse work for at least 10 years. So it really just covers rooms, meals, nursing services, equipment, operating room. Part B, this is the one that is the big deal that everybody talks about, of course, because that's where the big cost is and all the complexities come in. Substantial cost during retirement, you have the premium, the deductible, the copay, and the 20% or the 20% co-insurance. It covers doctor visits and services, outpatient care, just like your standard health insurance policy. Emergency room, ambulance, preventative care, medical insurance. So Part C is the Medicare Advantage. That's private insurance, may or may not have a premium. And it covers everything that Medicare Part A and B covers and more. And it does have an out-of-pocket limit. Part D is prescription drug coverage. Covers all types and classes of drugs normally used by Medicare patients. There's usually a premium and copay. Drugs are covered based on tiers. The higher the tier, the higher the amount covered. So Medicare supplement plans or Medigap plans, which are really popular, especially with our clients, the The AARP ones seem to be the ones that nobody can beat. Help pay some of the out-of-pocket costs, so classified letters A through N, and all plans with the same letter cover exactly the same, so have exactly the same coverage, but may differ in what they charge. Most Medicare participants choose Part A, Part B, and Medigap, as well as Part D. So enrolling in Medicare, again, the 7 months around your 65th birthday. But if you already are receiving your Social Security, then you will be enrolled automatically at 65. So if you started your Social Security early. If you're still eligible for a group healthcare plan at your employer, so you do not have to apply for Medicare until you retire, but you may want to get that as proof from your employer stating that your coverage through the employer qualifies as a plan that Medicare sees as full coverage. If not covered by your employer plan or not apply during the initial enrollment period, we've already discussed this 10% penalty. So here's the cost. So how much is Medicare going to cost you? So if you file jointly, if you make it less than $194,000, it's per person $165 per month, $164.90. But a lot of folks in this area, as a couple, make between $194,000 and $246,000. So you're looking at $230.80 per person. So that adds up quite a bit. Go back?
For 1 second, right?
Sure.
Thanks.
And these numbers have adjusted upward pretty aggressively over time. Now these tags, so these brackets also adjust, but they don't seem to adjust as much as inflation goes up. So again, so it kind of creeps up on you. So whereas you used to be a really wealthy person that made this much money, well, you're just comfortable in this area a lot of times, depending on the neighborhood you live in. So federal employee health benefit. So that's a nice benefit that federal employees have, and the government pays 72% of the benefit during employment and in retirement. And to be eligible for the federal employee health benefit, you have to be eligible for immediate retirement, eligible for pension at retirement, and have to have been an FEHB covered, so basically federal health insurance covered for 5 years prior to retirement. So there's a couple options here, or a few options with the federal employee health care plan as far as what you can do to get the most out of it. So option one, the lower premiums, higher out of pocket, just enroll in Medicare Part A. Of course, that covers your hospital bills. And then just keep your federal employee health benefit, and it just covers everything that Medicare doesn't. So outpatient bills are covered by your federal employee health care plan. Option two, this is the plan that a lot of people take. Well, option 2 or 3 really. So we have enrolling in Medicare Part A and B and keeping your federal employee health care plan. And there you have Medicare pays first and FEHB pays second. Pretty much full coverage there. Very low out-of-pocket expenses. But you're paying 2 premiums. You're paying the Medicare premium and you're paying your federal employer health care benefit as well. Premium there also. Give you a couple $100, $300. So the third option, enroll in Medicare Part A and B with Medicare supplemental plan, usually F, G, or N. You can't go back though, so if you do this, you give up your right to go back to the federal employer health care benefit forever. If you do this, you actually have to sign a form. So all bills Medicare pays and the supplemental plan pays second. option 3, I guess we are not counting to 4 today, we're just 2 option 3s. Can suspend your federal employee health care benefit with the option to go back to it. So you enroll in Medicare Part A and B with Medicare Advantage plan, Medicare C. So this way, if you don't like this approach, so let's say you don't like your Medicare Advantage plan, and you want to go back to your federal employer health benefit, you can do so later. So the insured pays the co-pays, the Advantage plan pays the balance. So, taxes and inflation in retirement. Let's look at some other strategies besides just Social Security and everything we've discussed so far that gets paid out based on earnings. So in general, inflation tends to trend with the amount of debt and the ability of a government to pay that debt, of course. The higher the debt load, the more the government has to, you could say, print money. It's a little bit more complicated than that, but let's just call it printing money to pay the interest on the debt. And it's kind of a self-fulfilling prophecy. It just goes up and up. So debt doesn't seem to be wanting to go down anytime soon, so it's not likely that the inflation and the lag in the COLA and the lag in tax brackets adjusting for inflation is not likely to go away anytime soon. In fact, I would bet on it getting worse. Of course, there's different types of qualified accounts. I'm guessing most or everybody here at least has a 401k or a TSP or a 403b or something along those lines. And of course, you're responsible for understanding what those options are. And you've earned all that money, you're getting close to retirement, and now you could lose a bunch of it if it's not done right. So, want to make sure we do this right. So, there's several Secure Acts. So the Secure Acts of 2020 increased the RMD age from 70.5 to 72, eliminated a stretch IRA for non-spousal beneficiaries. So government wants those tax dollars. So if somebody passes away and they're not a spouse, that stretch IRA distribution has to be taken over a much shorter period of time. But they did remove a contribution age limit for IRA accounts and a few other things as well. So Secure Act 2.0, which just passed, some new rules for retirees, which apply to a lot of people here probably. So starting this year, the RMD age increases from 70 to 73 from 72. So if you were turning at 72 this year, you can wait until 73 to take your, or you can wait until next year to take your RMD, or actually until April 2024, but you would have to take 2 RMDs that year, which means likely higher tax bracket for you. So you may want to just do 1 RMD a year. January 1st, 2025, higher catch-up contributions for individuals 60 through 63 to be able to, so if you have a retirement account at a TSP or a 401k, you can now add another $10,000 to that account per year and defer that from taxes. But of course, if you earn more than $145,000 in the prior year, then all your catch-up contributions have to be made into a Roth account in after-tax dollars, because they want to get those taxes. So up front. January 1st, 2024, IRAs, as of right now, the $6,500 limit, 2023, and $7,500 if you're 15 older. Starting 2024, the limit will be indexed to inflation. 24, Roth accounts and employer retirement plans are exempt from the RMD. Right now, your Roth, if you have a Roth in your 401k or in your TSP, you have to take the RMD if you've retired, but no longer. Student loan debt. So this obviously isn't for retirees, but you may have kids that have student loan debt, probably, or kids or grandkids probably do. So this is relevant, and you may want to let them know about this. starting in 2024, employers will be able to match employee student loan payments with matching payments to a retirement account, giving workers an extra incentive to save while paying off education loans. 529 plans, after 15 years, so if you're contributing to grandkids or nieces, nephews, 529 or something, this is a good rule to know. After 15 years, the 529 plan assets can be rolled over to a Roth for the beneficiary, subject to annual Roth contribution limits and an aggregate lifetime limit of $35,000. So if they're not using all that money in that 529 for a college education, maybe they got a nice scholarship, well, then that money can go towards their retirement or maybe down payment on the home or something. So overall, just a little bit about contribution limits. So if you have a employer-sponsored plan, like a TSP or a 401k or a 403b, the limits are in 2023 $22,500. That's up by $2,000 from last year. And your catch-up contributions again are $7,500. The TSP. So we just discussed the contribution limit. Some benefits of the TSP. So often people compare, should I move this over to an IRA account? Should I keep it where it's at? So again, everybody knows about the low expenses. The G fund is nice when you just want a nice safe yield. But limited withdrawal options, they're getting better about that, but in general, it's more of a pain, you could say, if you want to change something. Very limited investment options. Now, they've done better about that with the mutual fund window that they've set up last year, where you can have a bunch of different mutual funds as options, but that's only for 25% of the value of your account. The rest of it has to be in those other options. Employer matching, of course, you've got get the 1% automatically, then for every other percent, get a nice match as well, up to 5%. So do we know our taxes going higher or lower? Who knows, right? I would venture to say in real terms they're going higher, but it's not going to look like that. It's just going to look like they're staying the same or going slightly lower, but they're going to hit you up. Converting to a Roth IRA, heard Roth conversions. When would you do a Roth conversion? Well, let's say you have very high income or quite high, let's say it's $150,000, and then all of a sudden you both retire and you have much lower income in that year. Well, that's the perfect time to do a Roth conversion, because you will convert from an IRA to a Roth, to a tax-free account. You'll pay taxes on all of that conversion. Let's say it's $60,000. You'll pay very low taxes on that, because you'll be in a very low tax bracket for that 1 year. It's just a way to, it's tax arbitrage. So you're getting out of a potentially higher tax liability into a tax-free type of an account during a time when you anticipate that you will have much lower taxes. That's the way to use it. So this is a strategy which is used often in this area, especially for people who may have types of service, federal service, which allows them to retire early, or they just are well off and they feel like they can retire early, or be very frugal and retire early. So in general, you probably know that age 59 and a half, if you take money from your retirement accounts prior to that, then you are going to be taxed plus penalized 10%. So that's very painful. But there is a way here where you can be much younger than 59 and a half and still live off your retirement accounts without a penalty. So let's say you decide to retire at 45 like John here. He's got $500,000 in his retirement account. There are ways that the government has allowed for you to take a income from your investment account and avoid the penalty. So there's the amortization method, annuitization method, and the minimum distribution method. For the amortization and the utilization methods, John will use an interest rate of 3.98%, assumed to be 120% of the federal midterm rate, and his single life expectancy of 38.8 years. The results are as follows. Out of a $500,000 account, he's getting $25,000. Similar.
I'm sorry, but 38.8 years life expectancy?
Yes, because he's 45, so you've got a 45 plus 38.
Oh, I see. Oh, it's
Yeah.
added on. It's like, wow, it seems pretty young. Okay,
Yeah.
sorry. Okay.
No, it's fine. It's a good question.
No,
Somebody's
I
paying
was
attention.
like, whoa, I was
You're not
like,
falling
what?
asleep.
No,
I'm doing something right.
Okay.
All right.
Sorry.
So,
Makes sense.
all right. So we've got. So
Didn't even take it off.
this is the. Well, no, that's fine. So this is the most you can. You don't have to take this amount, but if you don't want to be penalized, this is the most you can take, and you don't have to use up your whole account. If you have $2 million in retirement savings, and you think you only need this much, then you could just put $500,000 into an account and use that account for these distributions. So John's financial need over the next 14 and a half years, he'll be using these periodic withdrawals. There's a minimum of 5 years that you have to take these withdrawals, basically. And then you can stop. Then you can wait until 59 and a half, and then you can just use the standard withdrawal rules. There are life insurance policies, I won't get into that too much here, but there are life insurance policies where you put a bunch of money into a life insurance policy, and it does allow you for tax-free withdrawals. It is out there, it is available.
You said this, but are you going to share your slides?
If you'd like, I'm glad to, or Elaine will send those out to you, or David. We can certainly do that. So a little bit about the market, because again, if you have a TSP, if you have any kind of investment account, folks often are interested in having a little bit of a discussion. So we'll make it fairly brief, but again, around inflation, so we've got inflation, the hidden tax. Again, we kind of mentioned that already. Here is about volatility, because we saw a lot of volatility, of course, in 2020, and then this past year, 22. About losses, given that everybody here is either retired or close to retirement. If you lose 10% of your portfolio, and you make 3% per year, you'll need 3.6 years to get back to even. 6% return, 1.8 years. 8% return, 1.4 years. If you lose, let's say 30%, it's going to take you 12 years to get back to even. At 6% return, 6 years. So the point here is, the closer you get to retirement, the more conservative you're probably going to want to be. New math for retirees. So if you start with 100,000 and you lose 10%, you're left with 90,000. You need 11.1% to get back to even. If you lose 30%, you're at 70,000. You need 42%, 43% to get back to even. Again, it's just the math. Probably seen the chart like this in the past, but I thought I'd share it nevertheless. If you lose 40%, again, it's going to take 66.7% to get back to even. That is not a good feeling. You see that on your statement. So, point here is, this is your portfolio in retirement, your mountain of safety. You don't want to descend too far down that mountain, because it's going to be very hard to climb back up if you're taking withdrawals during retirement. So returns are funny, math is funny sometimes, and rarely math is funny. I don't remember it ever enjoying it very much, but this case I find it pretty funny, because it's happening here in a bad way. You've made 10% per year, but you're down, really. So what you have to look for is, first of all, you want stability in your returns. And again, you just want to be more conservative. First, you want to think about preservation of capital, first and foremost. Then think about making a return on your capital. So, a little bit about.
Could you go back, what was that statement again? My average is okay.
So, a little bit about the market. This is what's happened. So this was COVID. This was the S&P 500, the U.S. stock market. It dropped off a cliff. Then the government stepped in with all kinds of stimulus. And then we had this nice rise upward and then back down. So you'll hear about no market timing. Just stay in the stock market, forever stocks for the long run and so forth, because it's very hard to beat the market. Well, you can see here for professionals, if they're doing their job correctly, not just collecting fees, what you can see here is there's a clearly defined pattern that emerges. And if done properly, you can see here this is called not day trading, not timing the market, but professional risk management. This is just a very simplistic way of showing just one of the technical indicators that we may use in managing risk in our portfolios. So when you see this nice wedge upward, this parallel trend upward, and you see this change here, all of a sudden this line gets broken and there's a downward trend now, this funnel downward. Well, you start thinking, okay, well maybe something has changed. Maybe we need to look at our allocations to risk assets in these portfolios for our clients who don't want to lose money in a down market. So that's just to show you that there are ways to control risk if you do it conservatively. Sequence of returns, assuming a $50,000 annual withdrawal, 2001 through 2020. So average return 6.91%, column 1. Average return 6.91% in column 2. So you see the earnings rate is in the third column of each graph. And you can see how much it matters when you make the big returns. So the big losses took place at the beginning of the 20 years in the first graph, and they took place at the end of the second graph. And you can see that what we ended up with is very different values for the account. So you see that $1.6 million more in the right graph than the left. So you don't want to be subject to volatility when you're looking at your retirement accounts. You want to make sure that things are managed in a way that you don't get hit like this unexpectedly, and you want to end up closer to here. Meaning, well, if you're just invested in S&P 500 here, you got hurt quite a bit.
So with that, just look at where the money is, how it's allocated?
Well, so if we're talking about conservative strategies, let me just click through these here.
Yeah.
So this is one approach. Right now, people are getting a yield on treasuries, even 4.5%, 5%. So one point about annuities, and again, the TSB, if you have a TSB, they offer their own annuity. What this chart is about, this is just an example of one of our clients. Now, this return was right after COVID. So this is an annual statement. May 6th, she got a credit of 16%. She made $118,000. So this is a lady that had a TSP account. She moved it into an IRA. During COVID, when all the portfolios dropped of our more aggressive clients, that we moved everybody out of stocks in February before the market dropped for the most part, but there was still some volatility. She's very conservative. So because this is a fixed annuity that's indexed to the stock market, meaning the insurance company guarantees that the account won't go down with their faith and credit. She lost nothing in so when she received her statement on 5/6/2020, right after the big drop in 2020 during COVID, she didn't have a return, she didn't make anything for the year. But she didn't lose anything either, so she was ahead by like 35% versus somebody that just invested in the stock market. Now in the next year, she made 16% because this account is partially tied to the stock market. Now yes, during that same period, maybe the stock market went up like 45%. But because she wasn't down 35 the year before, she was still ahead. And this year, guess what? She's ahead again. Now, I'm not saying that you're going to buy an annuity and that's the right thing for everyone and you should just buy annuities and you'll be really happy. Because overall, in the long run, you'll make, most people, if they invest for a few decades in an annuity, they'll make less money than if they invest in the stock market, if they take more risk, because there's no risk premium here. But as you get closer to retirement, this is one conservative strategy that can be looked at as part of a way to get decent returns that at least partially or potentially fully adjust for inflation. So again, so we've covered a lot of these topics already. Now, if you are looking for advice, what you want to think about is, do you feel like you can trust this person, the credentials? Are they trying to sell you something, or are they looking at your situation? Is this team trying to figure out what you really need and then trying to actually cater a plan to your needs? Here's our information. If you are interested in a customized Social Security strategy report, we can run that for you, no cost. Glad to answer any questions. Maybe so individually, so maybe at the end it might come up. Yes, that's basically it. So if you want the slides, we'll provide them for you. If you talk with Elena or David, you can take your name down, and if you want to write whatever you like, whatever commentary you like on these evaluation forms.
Yeah, we'll put on that valuation form if you want. The slides just say like print slide somewhere at the top, and I'll take your picture.
Okay, thank you.
That way it'll be easiest.
I have a very general question, if I may.
Okay.
When you start collecting Social Security at full retirement age, but you're still working, meaning that you're still contributing to Social Security, how does that work in terms of what you receive?
Well, it just gets added to your income, and 85% of it is taxed. So when you calculate your taxes.
No, I didn't mean that. I understand that, but if you collect at full retirement age and is still working,
Right.
meaning contributing to Social Security, your payment, is that increases, or how does that work?
From my understanding, that's actually a great question. I haven't had that question before.
That's the
but
only
so
reason I came here.
Yes, so I don't have an answer
Actually,
for you.
it does
I don't
increase
have-
your benefit.
So there you go.
That
that's your
happened to
answer.
my
Yeah, I didn't
husband.
have an
I
answer
didn't
for
hear.
you.
It
increases
It does increase, yes, because.
But how does it calculate it? I mean, how?
Well, so
In monthly or next year or?
well, it's going to be yearly. I would think it'd be yearly because the government goes off your taxes, and for them to have the calculation, you need to submit your tax return to the IRS. So it would be a yearly calculation. But if you came here for just that one question, you could have just given us a call. If we don't have an answer, we'll just figure it out and tell you. You don't have to come here for just that.
But isn't there a limitation that even if you're at full retirement, right? Isn't there a limitation how much you can earn?
No.
Or you can earn anything you want?
Well,
Yes.
there's a limitation on the amount of which the taxes are calculated. So I can give you, it's about 147,000, which is the maximum at which we'll have to go all the way back here. It's around 100, so the calculation, the taxes are taken from a maximum income of $147,000. But you can earn as much as you want, but there's a maximum of which the taxes are calculated. Go ahead.
Thank you for the presentation.
Sure.
My question is more about the age, the full age of getting Social Security. I'm born in 1960, so I'm 62. I just learned that my full retirement, I can get it on 67. when I'm 67. In the presentation, there is a mention of 72, it's going to raise 70 to 72. That nuance, I didn't get it.
Well, so the 72 is for RMDs, for required minimum distribution from your retirement account. So that's not
So it
Social
has
Security.
nothing
Yeah,
to do with
it's
Social
two different things. But again, glad to answer those questions.
Can you talk a little bit about what RMDs are and how much they are, or anything like that?
Sure, so the required minimum distribution, you have to, so the reason for the required minimum distribution from your tax deferred retirement account is the government wants their taxes off your income. And for them to get the taxes off your income, they want, you have to take the money out of your retirement account. So you have an IRA, when you put money into your IRA, you're not taxed on the income, on the amount you put in. So, and the government does that to encourage you to build up for your own pension. So when you do retire and you have lower income because you're not working, then you're taxed at that point when you take the money out. If you don't take the money out, the government says, well, I need to get those tax dollars. So how do I do that? Well, I require a required minimum distribution. I require a minimum distribution from that account. It's based on your life expectancy.
And is that a certain percentage of your?
Yes, it's around 3.6% to start, and then it goes up from there.
And after you die, that goes to your people who.
Whoever the beneficiaries are. If it's your spouse, then it just gets transferred to
My
their
mom
account.
just died, and I just got one of those.
Sorry to hear that.
Well, she was 96, she had a good life.
That's great. Yeah, so then now you have a shorter period, whereas you could have taken it during your life expectancy before, stretch IRA. Because you're a non-spousal beneficiary, now you're going to have to do it over a much shorter period of time. Because again, the government wants that money quicker. Because they're hard up for tax, they're hard up for dollars now, with all the rules there. Any other question?
Go ahead.
Yeah, go ahead. Yeah, I think you were slightly medium flat.
Sure. If you, like I started taking Social Security at 65, so I'm 68, but I don't know if you can still do this, but I recently got an inheritance.
Sure.
So I was thinking about paying back the Social Security that I've gotten already to get a higher amount.
Sure.
Now, can you still do that?
Yes, yeah, and we can look at that strategy closer for you. There's some intricacies there.
Because I was wondering if you had to like pay some sort of interest.
Well, you have to think about whether or not it makes sense to do that. I mean, you might, just because you have an inheritance now, why would you buy
Because my
back
mom
your?
lived to be 101.
I see. There you
That's
go.
why.
Good answer.
That's why.
See, you're doing the math. That's good. Well, then yes. Again, that's just a general answer, but I can help you figure that out if you'd like more specific. Yes, please.
I'm gonna be 70 next month, and so RMDs are looking like, you know, a train approaching. And I started taking Social Security at 62 because I don't even need the money, but it just galls me at the taxes I might have to suffer.
Right.
Which I guess it's a great place to be in, but you know, it's like, damn it, I worked for that money.
Right.
And is there a, and I'm actually hesitant, afraid, I don't know how you want to put it, to go in and calculate what the RMD is going to be for my IRA, you know, my traditional IRA.
Sure.
Is there someplace I can go to, you know, is there a website that does that, or you?
Well, we're glad to run that for you free of charge. There are websites where you just RMD calculator, if you type that in. It's based on the end of the year value of your account. But you said you're just turning 70?
Yeah.
Well, then you don't have to worry about it for a few years.
Well, 2 or 3 years when you're 70 is like, you know.
Time goes fast.
Well, when you're 10 years old, another year is like, oh my God, that's
Right,
10% of my life.
3 years plus.
2, yes, and I'm like, you know, and
I know what you mean. That's
If you have more than one 401k, this RMD you have to take from each?
No, you can do it all from one, you can combine them. You don't even have to combine the accounts.
They're on their own place.
Right, but you don't have to combine the accounts, you can combine the distributions from one account. You can have 20 different IRA accounts and 401k accounts and SEPs, whatever, but you can take the distribution from just one account. You can just, but you have to do it, you have to know what the calculation is for all the accounts together. And again, we often have to do that for clients, so that's, but usually folks just combine. But that's a quality problem to have, sir, if you
Well, the other
how
thing-
big your distribution is going to be. at
The other thing they
3.6%.
sneak in on you is if you exceed the limits, on your taxable income, it's gonna raise my social security. I pay like one.
That's exactly right.
I'm like, you
Yeah.
bastards.
That's right. That's actually the strategy we discussed. Because they get you with, that's, you did the right thing in taking it early. You're taking your, Social Security early.
I had a friend, and I had a friend, and I said, look, you don't need the money, go ahead and take it. He goes, no, I'm gonna wait till 65 because I'll get more. He died before turning 65.
Well, unfortunate, yeah. Doesn't get to use it.
I have small question.
Gary,
Yes.
maybe this is not very much related. How long we have till end of the month, or it's too late to invest into IRA?
That for the previous year.
for
Until April 15th, until you file your taxes, basically.
Is that right?
Yeah.
Because we called Vanguard, said, no, it's too late. You have to do it before
And I
end of
called
the.
Empower, I said, I want to contribute
So
from
he's
last
wrong.
year, they said no.
He's wrong, yeah.
Okay, that's good.
Thank you.
Thank you.
Sure. Any other questions or anything else? Again, if you,
I was just gonna bring up that social security supplement that I never was aware of until I put my retirement papers in.
sure.
I'm like, why am I getting a social security supplement? I made the decision to retire before age 62,
Mhm.
and I'm like, who is running this government? I mean, I don't think I earned it, but I'm not gonna turn it down. Because it was, what I understand, it was designed for air traffic controllers and law enforcement, because they had to retire by age 60. So they got a social security supplement. It was just a ridiculous, I mean, there's no good reason why I could not have still worked another couple of years, other than I just didn't want to. I got used to having, when the government shut down and we were furloughed. I got real used to being furloughed, and I'm like, this is pretty good.
I hear you. No, I think a lot of folks took to it pretty well.
No, I'm just kidding. I said, I'm.
By the way, so is there any other questions? I mean, we don't want to hold anybody up. Please feel free to take another sandwich. And that's basically it. Great
Thank you.
having you pay attention to our conversation.
You get a complimentary consultation.
Yes.
Like,
Thank you.